Good afternoon, ladies and gentlemen. Thank you very much for taking some time out of your day. I know today actually looks pretty good. We arrived on Tuesday night and it was windy and it was cold. And my assistant fund manager, who it's her first time to Australia, said, "This is what Australia is. What happened to blue skies and the things you see on those tourism ads?" But you put on great weather for the last 2 days, which is fantastic. So the global environment in which we live in today is obviously very uncertain. And last week, I had the opportunity of seeing John Howard at the BlackRock Symposium. And some of the key takeaways I want to share with you this afternoon. The first key takeaway is that today, there is 72 trillion US dollars of cash in deposits, and then there is 70 trillion of money employed, invested in assets. There is this much cash sitting on the sidelines now. 12 months ago, we had $700 billion of negative interest rate bonds. Today, we have 10 trillion, 12 months later. We sit in an environment whereby this global experiment of printing money, we don't know where it will end, and it is challenging the way that we provide advice. And for those of you that are first-timers to our presentation, one thing, as you know, is I'm a financial advisor just like all of you in the room. Therefore, the challenges that you face are exactly the same challenges that we face as a business. So what we're going to present to you today is a couple of things, and today is probably the most packed roadshow we've ever had in terms of content. And because we've had a lot of development with both our funds, as well as with new strategies, which we believe will add some value to your clients' portfolios going further. So that's why we're going to try to give you some certainty in an uncertain world. Disclaimer, as per usual. Now here's an article that I brought up from Ross Gittins. Does everyone heard of Ross Gittins? During my high school, he came and toured our high school and explained to us what the economics of the world was going to be like for the next 12 months. He was fantastic. And he wrote this article on August the 3rd. And I just draw it out, and it's got very little to do with Australia, and that's not the point I'm picking on. But he just came back from a field trip to China, and I want to share a couple of quotes with you from that trip that he just did. So he said that so many of us have outdated perceptions about China, that it's poor, it just creates cheap clothes in sweatshops. And that used to be true, and that's a perception a lot of people had. But now, it is a country anxious to get rich gloriously. And that's the key point. China is no longer a place where it's just a whole set of villages and everyone's stuck in a developing economy. It is a fast-growing, developed economy. And by no means do we think that the growth rate is going to stay this way. It will even out. But the fact of the matter is that this is a place where people have had the taste of capitalism and want to run with that going forward. So in the Tianjin Free Trade Zone is a factory of Airbus, and everything they produce there is sold to China. And a lot of people think that a lot of Chinese technology doesn't come from China itself, but it is stolen, or IP rules are taken from elsewhere in the world without recompense. But that is further and further away from the truth today. And we're going to share some stories about some technology that China is now exporting to the rest of the world. So don't be so sure, because for those of you that have been to Hong Kong, you may have gone to Shenzhen for a taste of shopping. And today it is now an IT hub, where the property prices in Shenzhen last year went up 60%. 60%. And the question always goes about, is it sustainable or not? And we're very fortunate to have Yan here, because Yan is an assistant fund manager with Value Partners that focuses on both property as well as financials. And I found the funny point is that he bought a Chairman Mao cap with a red metal star, which is the thing that you do when you're in China. But today, Shenzhen's got 10 million people with an income of $29,000 per head. And the amazing part is 45% of its area is parks and forest. So they're about protectionism as well. So they're building all their apartments up, just like we see in Sydney and Melbourne, and not out. It has still some low-end manufacturers, but it's being encouraged to move to the inland, or it's no longer even competitive advantage that China's labours hold. In actual fact, one of our holdings, which is a glass company, has now built a factory in Ohio in the United States because it's more competitive. So China is a big place, and we're going to discuss how big it is today. And when we talk about property, you'll see it to be even larger than you may think. And they're always looking for a better future. So that's the context I want to set out today. So here's the agenda. Corporate update on value partners. Alan's going to talk about the China market, what's happening with the China fund. Property sector is the update from Yan. I'm going to go through Milliman managed risk. This is something that some of you have seen me present on in the last couple of months at some roundtable sessions I did. And that is a way for you to access China with a lower level of volatility on our overarching fund. So for those of you that have heard of Plato Australian Share Income Fund, Beta Shares ETFs, or Colonial First State Sandlam funds, these funds all have managed risk overlaid on top of it. Then I'm going to talk about the Premium Asia Fund and the portfolio update there. And finally, we're going to talk about fixed income. Okay? And that's our most exciting part. And I'm going to challenge your thinking with this is going forward, given the rates and how much risk you're willing to take for your client to derive an income, consider that tier 2 type fixed income products fall into the growth component of your client's portfolio. Because in 2007, you only needed to take less than 3% standard deviation risk to get 5% yield. Today, you need to take 6.5% risk standard deviation to get a 5% yield. That is the reality that we face. So corporate update, nothing's changed. Business as usual, 2,500 companies a year that we complete in company visits, 360-degree reviews. And the key element is that we just spend far more time on the qualitative side of looking at a business rather than the quantitative side. We're still worried about corporate governance. You're still worried about corporate governance. We look through all of that. And through all the even one-on-one meetings we're having with advisors in all the cap cities this year, everyone has been very, very impressed with the level of in-depth knowledge that we have on the ground looking at China, because it is simply not an easy asset class to get your head around. This is our senior investment team. The people on the left-hand side that's highlighted in red are running all our 4 individual strategies, ranging from Renee, who runs our Premium Asia ex-Japan fund. Alan runs the Premium China fund. Michelle runs the Premium Asia Property Securities fund. And Gordon runs our fixed income fund. We are still the only asset manager in the world who has operational jurisdiction across all 3 parts of China, being Hong Kong, the mainland, as well as Taiwan. Our investment team now comprises of 58 men and women covering 5 different offices, as you can see here. It's exceptionally well-resourced. The long-term track record, we're now at 24 years of track record since 1993. The annualized return of the Classic Fund is 14.6% versus the Hang Seng Index of 7% per annum, less than half, and infinity more times performance than the MSCI China Index. More than ever are we seeing assets now being pushed up, and BlackRock coins this effect the TINA effect, T-I-N-A, otherwise known as there is no alternative. And the biggest black swan event that they predict is that more money is going to flood into equities or other types of investments, pushing up prices to allow a further deviation from fundamentals. And that is the biggest risk that BlackRock sees. These are our strategies, and we're going to go through 3 of them today. People keep asking me, Jonathan, does active performance work? Do you still believe in active performance in a place like Asia? It's fraught with danger. Can you add value for my clients? I can proudly say that for the China Fund, having 11 years of history, the Asia Fund having 6 years of history, and the Asia Property Fund having 8 years of history, this is our total outperformance, net of fees, to your clients. All fees. And that's against the MSCI China Index, the MSCI Asia ex-Japan Index, and the FTSE Nareit Index. So these are the indexes that the world uses to compare what our performance looks like. What's the most ironic part of it is the more outperformance we have, the less investors we have too. You're taking the same risk for those of you that invest in our property securities fund. It has the same level of standard deviation as the China fund at about 20 to 21%, but a return profile is actually higher because we're playing a very specific sector. And you're going to see the theme of property go throughout today's presentation because it comes across the China fund and the fixed income fund like hand in hand. So I'll hand it over to Alan now, and this is Alan's 5th trip to Australia, doing our roadshows, and this is his 14th year with Value Partners. And Alan's going to give you an update on China, where we've gotten right, where we've gotten wrong, and where to from here. Alan.
All right. Good afternoon, everyone. Like Jonathan said, this is my 5th trip to Australia doing roadshow with Premium. And obviously, some of you might know me from the past presentations. So today, I'm going to share with you what has went wrong with the performance of the Premium China Fund over the past 6 to 12 months, how we will be positioning ourselves for the next 12 months, and also addressing some of the issues that you might be concerned of, things like the China's GDP slowdown, the debt issue in China, as well as the controversial, but what we see as opportunity in the property sector. This is the performance of the Premium China Fund for the past year. Unfortunately, the performance has been that great over the past 12 months due to volatility, particularly in the Chinese equity market. Now, from a top-down macro to micro perspective, we can attribute the underperformance of the Premium China Fund under 3 factors. The most macro factor from a top-down perspective is the performance of emerging markets versus developed markets. For the past 2 years, with expectation regarding US Fed hike, investors globally have been switching their allocation from emerging market to US dollar denominated US assets, particularly in the developed markets, as well as the US equity and bond market. China, being part of the emerging market, obviously was not immune from that, and there was a lot of liquidity from the Greater China space. The second reason for the underperformance of Premium China Fund relates to our exposure to Chinese A shares. As you know, year to date, the A-share market has been underperforming even the Hong Kong-listed Chinese equities. The Hang Seng Index year to date is about flat. The Hong Kong-listed China companies are down about 6% year to date, while the A-share index is still down 15% year to date. To make matters worse, the Chinese regulators, even though with good intentions, has in a way added more fuel to fire on the already negative sentiment towards China. One example to illustrate that is the circuit breaker rule at the beginning of this year. Something was meant to reduce volatility in the market, but ended up exaggerating the already negative trend for the A-share space. We have about 15 to 18% exposure in the A-share space over the past 6 months. We're confident that our stock picking the A-shares are good. The fundamentals of the company we bought are intact, but the systematic risk of the A-shares has also dragged the share prices down. And that has led to our underperformance versus MSCI China index, which does not have A-shares within the index. The third and final factor regarding our underperformance relating to the style of investment. For the majority of China fund managers out there today, particularly for the larger global branded funds, such as BlackRock, Fidelity, Templeton, HSBC, Schroders, etc., they have been switching from China mainland equities and buying more into the Hong Kong blue chips. And the reason is very simple. They need to invest, they can't raise cash, they need to have Greater China exposure, but at the same time, they do not want to have direct mainland Chinese equity exposure. So they end up buying the Hong Kong blue chips which are perceived as defensive because they have less exposure to the mainland economy. So, Hong Kong property share prices, Hong Kong utility share prices, Hong Kong infrastructure share prices have been pushed up to very high valuation levels. But we do not believe that this herd behavior is in the interest of our investors. For us, we'd rather stick to what we have been doing for the past 10 years, maintain a consistent investment style in picking stocks that are undervalued, oversold in the China equity space, rather than just follow the bunch of other investors and hide your money in something that's already overvalued and overplayed. The downside of that is, of course, it did add more volatility as well as underperformance to our portfolio. This is our top 10 holdings at the end of July this year. And as you can see, it's actually spread out among a variety of sectors and industries. Later on, I will talk about some of the top picks, which have very certainty in terms of earnings growth over the next 2 to 3 years. These include opportunities in the services sector, tech sector, and export industries. We also will talk about some contrarian opportunities, particularly relating to the China property industry. But first, let's talk about the Chinese economy. GDP is slowing down. We've been saying that last year, the year before, and we're saying it again this year. Even though GDP growth has been 6.7% for the first half of this year, but a sharp recovery is unlikely in the foreseeable future. So China's economic growth will be L-shaped going forward, with a gradual trend towards the downside. More importantly, though, you can see from the chart that services sector since 2012 now accounts for 50% of China's GDP, already overtaking the manufacturing sector in the past few years. And also, the growth rate of the service sector is also much faster than that of the manufacturing sector, now as well as going forward. So we believe that the contribution by the service sector towards GDP will only increase over time. And that's something important to keep in mind. People worry about the over-leverage of the debt situation in China. We believe that the government sector, both the local governments as well as the central government, is not overburdened by debt. And more importantly, we believe that the household sector is actually under-levered. The debt level are comparatively low by any global standard. By culture, Chinese households do not like to live on credit, and the major form of borrowing that they have accumulated over the years are predominantly mortgages. The sector that is most under pressure in terms of high debt or leverage is the corporate sector, particularly state-owned enterprises. State-owned enterprises who have suffered from overcapacity, excess inventory, particularly in the middle to upstream industries, such as commodities, coal, cement, steel, heavy machineries, are the ones that are truly at risk. Unless some drastic reform on the state-owned enterprises, as well as restructure of the debt profile through means of debt for equity swap or setting up new asset management vehicle to offload some of this debt, it will be an issue that will take many years to resolve. The reason that the SOEs are heavily burdened by debt also relates to their funding channel. China, compared to places like the US or even Japan, heavily relies on bank debt for corporate growth, corporate funding. On the other hand, the capitalization by the equity market or even the fixed income market are still relatively low compared to many Western countries. That is exactly why the Chinese regulators need a healthy and stable capital market. It's in no one's interest to have a volatile and backward-looking equity market. So we believe that the continued integration of China's capital market with the rest of the world will be a trend that will continue on for many years to come. Beyond the equity market, the fixed income market has actually made more progress in terms of its reform as integration with the international community. The renminbi will be included in the IMF's special drawing right from 1st October this year. China has already opened various channels for the world's central banks and sovereign funds to purchase renminbi-denominated fixed income assets from now and going forward. That actually says a lot regarding the opening up of China's capital market. If you think about it, the majority of the world's central bank hold vast part of their assets in fixed income securities rather than equities. And given that today, Europe, Japan are both in negative yield territory, the US bond yield are also going down sharply, China is one of the few remaining places where at least interest rate differential still remain attractive. But of course, one need to think about the currency factor as well, which I will talk about now. Actually, I'll talk about in the slide after. But before I go on that, regarding the healthiness of China's banking sector, we believe that Chinese banks are in a much healthier position compared to 20 years ago, just prior to the Asian financial crisis. The Chinese banks, whether it be estimated or reported, they have a lower NPL ratio compared to them. Even in the most extreme case, if you believe Chinese banks have 15 or even 20% NPL, that's still way less than 35-40% back in 1997. At the same time, this potential NPL risk at least is backed up by a very strong deposit base by the Chinese household and a very strong provision in terms of RRR ratio by the Chinese banks themselves of 17.5%. The capital adequacy of the Chinese banks is also much healthier compared to 20 years ago. So are we cautious regarding Chinese banking sectors? Yes, we are. At some stage, the Chinese banks might need to take a hit and write off more of its NPLs. But is it going to be a banking crisis that will be out of control and spread out to the rest of the economy or even to the world? We don't think so. We believe that the Chinese regulators, the banking system liquidity, as well as a vast deposit base is sufficient to contain a spread of the banking crisis that might be worse than one anticipates. So we will not buy the Chinese banks now. There are risks for them, but we're not concerned regarding any hard landing or widespread banking crisis in China. China has a full reserve of $3.3 trillion at the end of 2015. The latest figure is that the reserve is now 3.2 trillion at the end of July this year. So the reserve has come down about 3%. So far this year, the renminbi has depreciated by about 2.5% year to date. Now, it was exactly 1 year ago, 11th of August 2015, that the central bank in China had a sudden devaluation of the renminbi. And obviously, that has spooked the market. The communication, the way they have managed market expectation was very bad. And that led to a volatile currency trading movement in the 3 months thereafter. And renminbi had a sharp depreciation at the beginning of this year also. But since then, the regulators, as well as the central bank, has been much open and better communicated with the market regarding its intention on the currency. And that's why in recent months, as recent as June, when we see a depreciation of the renminbi, the market was less volatile and less spooked by the behavior of the currency. We believe that the renminbi will probably have another 2%, 1.5% to 2%-ish depreciation for the remainder part of this year. And we're still looking for annual depreciation around 4 to 5% in 2017. But that said, we do believe that expectation management is important. And if that occurs, market will be less worried or less volatile regarding movement in the currency. We don't think that there will be any more one-off devaluations of the currency by the central bank. So moving from macro to opportunities. One of the things that, or the key milestone we look at regarding how we position our portfolio are the reforms or the integration of the capital market that has been either done or upcoming. For those of you who have listened to my presentation in the past, I talked about things like the Shanghai Hong Kong Stock Connect. I talked about the renminbi's inclusion as SDR currency, as well as the One Road, One Bill initiative by the Chinese government. The catalysts we're seeing going forward include the Shenzhen Hong Kong Stock Connect, Asia's inclusion into the MSCI China Index, also MSCI Emerging Market Index over the longer term, as well as reopen of the QDII2 program, which stands for Qualified Domestic Institutional Investors. The QDII2 program is more relevant for Chinese financial institutions such as insurance companies and pension funds to invest abroad. It actually gives them the ability in terms of quota, license to invest more money offshore. And if they do that, obviously, capital markets such as Hong Kong, Singapore, or even the US, Australia might benefit. MSCI's inclusion of Asia obviously is more beneficial for the Asia market over the longer term. That did not occur this year. We think that the chance of occurring in 2017 or 2018 will be much higher. But more immediately, we're very much interested in the launch of the Shenzhen Hong Kong Stock Connect program. Yes, on the surface of it, the Shenzhen Hong Kong Stock Connect is just an expansion of the existing Shanghai Hong Kong Stock Connect program. But the implication is much more than that. On the Asia side, it encompasses both stock exchanges rather than just one. On the Hong Kong side, it will expand the existing universe of stocks that's actually available for purchase by mainland investors in Hong Kong. The current program only encompasses 315 stocks. With the extension of the Shenzhen Stock Exchange, that will expand to more than 500 stocks. And also more importantly, the quota that currently remains for mainland investors to buy into Hong Kong stocks is less than 50 billion Hong Kong dollars. Hong Kong's daily trading volume is about 60 billion Hong Kong dollars, so it's less than 1 day's trading. That quota is running out by billions every day. Over the next 2 months, it'll be all used up. So we need an expansion of the quota itself when the Shenzhen Hong Kong Stock Connect program is launched so that more fund flow can be made from the mainland into Hong Kong. And given that where Hong Kong market is today in terms of valuation, it makes a very good risk-reward opportunity set for people who want to invest in the Hong Kong equity space. Now, how do we go about making our investment? A large part of our portfolio right now is looking for certainties on a corporate level. Certainty in terms of growth profile of the next 2 to 3 years. Certainty regarding high entry barrier so that keep off competition. Certainty where the customers are blue chip. Certainty in terms of the quality where there are less risk of fraudulent or non-transparent activities. These are the type of stocks that we are looking for in this uncertain and volatile macro world. Another set of opportunities we'll look at are contrarian opportunities, particularly in the property industry. My colleague Yan will share with you on that later on. 3 examples of global manufacturing. The first one is a company called Sony Optical Technology. It's a tech company. It makes cameras, lenses, and modules for your handset, as well as for your cars. On the handset side, Huawei recently launched a phone called the P9, which uses dual camera. And the lens is branded Leica, but it's really made by Sony Optical. The Apple's iPhone 7 to be launched next month. The rumor is that we'll be having dual camera as well. Dual camera phones definitely offer better quality in terms of the picture quality versus the existing ones. And it will be a major trend for smartphone handsets going forward. Sony Optical is the biggest player in dual camera using handsets in the non-Apple, i.e. the Android-based platform. On the auto side, Sony Optical has 40% global, not China, global market share in cameras fitted in cars, particularly auto-reversing cameras. By the year 2018, the US government has legislated that all new cars produced and sold in the US must have reverse camera fitted onto them. Not to mention continued expansion of that of 360-degree cameras for high-end cars that help you park, advanced driving systems, ADAS, and even unmanned vehicles. The more difficult it gets in terms of artificial intelligence in driving, the more cameras you need. And Sony Optical's blue chip customers include Google, Oculus, Sony, Toyota, Ford, General Motors, Tesla, you name it. These are all blue chip customers. So the certification process is not easy. It took them many years to get in as supplier to these customers. And obviously during that process, the customer also vets them regarding the quality, the transparency, and the like. We bought this company 2 years ago before everyone looked at it. We bought it for the Premium China Fund at an average cost of $9.33. Today, the stock is trading at $35 per share. The only mistake I've made on this stock is I didn't buy more when I could. Something slightly more boring. Fuyao Glass. What they do? Auto glass. Front, back, windscreen, side panels. That's it. 80% China market share. So if the Chinese auto industry does well, the company will do well, and vice versa. But that's not what something we're looking for. We're looking for global expansion. The company set up a plant in Ohio, United States last year. That plant is already break even as we speak in the third quarter of 2016. It produces and sells directly to large blue chip customers, auto companies. Again, to get certification by these customers is not an easy process. And moreover, this company has a very attractive valuation. 12 times PE, double-digit ROE, 5% yield, with about 15 to 18% growth per annum, particularly after the US plans start to contribute profit from the year 2017 onwards. Again, it is a Chinese company, but its customer its business is much more global than people might think. Shenzhou International, I won't repeat all the same similarities, but it has the same good customers again, like Adidas, Nike, Uniqlo. But this company, being one of the world's largest textile manufacturer, have 50% of its production base located in China and another 50% located in Vietnam, benefiting from the TPP relationship between the Southeast Asian economies and the US. So, is it really a Chinese company? Yes, but it's now have manufacturing base outside China as well. So all three companies share one similarity. They're export looking, they have global customer base, and they benefit from renminbi depreciation as well. One other thing to note is that all three companies were founded and run by private entrepreneurs. They're not state-owned enterprises. And that's very important, which I'll go into a bit more detail later on. Another sector that we do look at, although quite broad, is the services industry. As I mentioned earlier, services now account for more than 50% contribution to China's GDP. And services industry will grow much faster compared to the manufacturing sector. Demand for steel, demand for coal, demand for cement will at best be stagnant going forward, or even decline in some places. But demand for services will only pick up, particularly producer in the service industry such as e-commerce. China is the world's largest e-commerce market. Alibaba is the world's largest e-commerce company. But to support e-commerce, you need a fast-growing logistics industry. So people ask me, what happened to all those workers working on construction sites? They're now riding the scooters, making deliveries in cities. They have become couriers for the e-commerce industry. That's growing extremely fast. Then you have social service industries, things like aged care in an aging population environment, education, entertainment, tourism. Those are areas that are growing very fast in China at the moment. Now, look at the chart on the left. We all know that China runs a balanced payment surplus. But did we know that almost all of its surplus come from the manufacturing sector? China was branded the world's factory since it joined the WTO in 2002. So in the following 10 years, China's commodity exports in terms of goods has been very strong. But on the service sector side, things like education, healthcare, tourism, China is a net importer. There are definitely more Chinese students in Australia than Australian students in China. Chinese outbound tourists has spent $250 billion in 2015 around the world. But I'm sure that that number is much less for foreign tourists who spend in China. Even Chinese women who might go off to other countries for healthcare services like facelifts or whatever. I'm pretty sure no one wants to go to China for healthcare service or even medical checkup. So in a way, the services industry is actually running a trade deficit. If we look at the chart on the right-hand side, remember I mentioned that some of these examples of companies are all private entrepreneur-run companies, and they are very good at export. These predominantly focus on the lighter industries like auto glass, textile, furniture, toys, and some tech components. On the heavy side, commodities or heavy machinery, Chinese export is not that strong. The Germans, the Japanese are doing well, but not the Chinese. So in a way, the heavy industry are much more controlled by the state, like SOEs, while the export sector are much more driven by the private entrepreneurs. So one can conclude with some deductions that the sectors that are less influenced by the state are actually doing a lot better on the global stage. And right now, the services industry is in the same sort of conundrum. A lot of the assets in the services industry are actually controlled by the state. The top universities in China are state-owned. The top hospitals and doctors are state-owned. The top tourism sites, the Great Wall, the Forbidden City, is owned by the state. So, if the Chinese government is willing to liberalize and reform the services sector with more private entrepreneurs that get involved, I'm pretty sure that the service industry will enjoy the same sort of flourish and boom as the manufacturing sector in the 2000s. And that's where the potential lies. And we're already seeing signs of that the service sector becoming more and more non-state controlled. One example of that is obviously a company that everyone might have heard about called Tencent. Tencent is one of the largest Chinese tech companies out there. It has social networking applications called WeChat, which has more users than WhatsApp or Line. It has online gaming. One of the more recent acquisitions was Supercell, the maker of Clash of Clans and Clash Royale. It has online payment called WePay. The other big players is Alipay and Alibaba. It has live streaming of events, and it has lots of online advertising. It's not a small company anymore. The company has a market capitalization over $220 billion US. But its potential to monetize its literally hundreds of millions of users is very large. And Tencent is a company out of Shenzhen, non-state-owned, and has benefited from an increasing population that are more and more reliant and spending more on the services sector. Earlier this year, a CNN reporter spent a whole day in Beijing using only his mobile phone and WePay to survive, from accommodation to restaurant to taxi to buying goods and services. All he needed was his phone and WePay. He did not have a single dollar of cash on him. And this shows that how sophisticated the service industry in China has become. And we believe that this trend will continue going forward, and this is where we look for the opportunities. Now, these are obviously opportunities where we see with a high degree of certainty, and we have incorporated that into our portfolio. Even though the recent sentiment towards China as a whole has been very poor, where a lot of the share prices decline was more driven by a derating of the price themselves rather than change in the fundamental or the earnings growth of these companies. So we believe that we will recover from the current macro volatility, and our fund will perform very strong going forward. Just as was the case after 2011, 2012, when back then the macro uncertainty was also very high, and we subsequently recovered very strong. Now, just turning the temperature a little bit, Yang will talk about how we see the property sector, which is more a contrarian call, where we see a dislocation between the physical market versus the publicly traded companies that operate in that industry.
Good afternoon, I'm Yan. I'm going to talk about China property. Today I'm here, I want to share with you some facts and some data of real China property. Maybe a little bit differences from our news we read every day. This is a big picture of China property. When we talk about the sector, we mean the whole country. But in our view, we believe the China property only in the 53 cities, the top 50 cities in China. Why we say that? Because there are more than 600 cities in China, 300 small-sized and 300 middle-sized. For the small-sized, we can call them county. And the differences among the cities could be very huge. So from our view, we should divide the cities into 3 groups. The first group, we think the market is quite good. The top 10, the top 11 cities, upper-tier cities. And the second group is 42 second-tier cities and others. Actually, for the top 50 cities, we see most of business there. It takes up 50% of area sold in last year. If in terms of sales value, it up to 64%. So from our perspective, in next decade, the sales value in the key cities would up to more than 80%. So as long as these cities are performance, we think the China proper market is good. And from the news, we got that there are some ghost cities or very lower tier cities in China. But we think it has limited impact of the total, because very small investment and very demand there. So we should pay more attention on our key cities. For the key cities, we have very strong economy and very decent population growth. And fortunately, most of our listed developers only have business in our key cities. And this is the very big picture of China property. Let's turn to some details for the sector. Firstly is inventory and then demand. From the left picture, we can see that our inventory level continues to drop since 2 years ago. I think the peak point is September 2014. And if we use the data inventory versus monthly sales, for our tier 1 cities, it's only 8 times. For our tier 2 cities, it's only 11 times. But more than 1 year to digest the inventory in the tier 3 and the tier 4 cities. And from the right picture, we can get that. I mentioned in the last slide, our key cities account for 50% of total sales, but it takes only 40% of inventory. So inventory may be a problem in China, but not in all cities. In this slide, I'm trying to give the future demand calculation. And for next 5 or 10 years, it's really hard. Based on our calculations, we believe 1 billion square meter annualized demand would be sustainable for 5 years. And the data would decline to 0.9 billion square meter after 2020. Our calculation has 3 key assumptions. The first one is 0.5% population growth. The second one is 1% urbanization rate increase. The third one is 0.5 square meter per capita living space increase. We think our assumptions are quite conservative because the data is below our real data in the past 3 years. And you may know that we also have a buffer. Last year, our government finally released the second child policy, and this will be a long-term catalyst for this sector. Actually, based on our calculation, based on our analysis and research, we are confident for the market in long term. But in short term, we're a little bit concerned, because in the past 18 months, the sector is overheating, especially in the tier 1 cities. The property price rest a lot. And we think this situation will change in next 2 years. We see the market structurally cooling down in 2017 and 2018. Maybe currently it's not a good time to buy an apartment or a house in China, but we may think it's a good time to buy China property names in stock market. Why we say that? Because the physical market and the stock performance diverged massively in past 1 year. Most of our property names listed in Hong Kong are trading largely below book value and also largely below net asset value. And thanks to the very strong sales in past 2 years, our developer have very rich cash in hand, improving margin, also lower leverage than before. So we think this situation will change in second half. These stocks will be re-rate. So generally, we are positive to the big caps listed in Hong Kong. We like Collie, Sierra Land, and we also like some selectively middle caps. Shanghai urban development is our topic for the middle caps. Why that? The stock is a SOE firm. Currently, it's trading 0.7 times PB. It's quite low valuation. And it has very strong earnings, more than 20% in 2016, and maybe double-digit growth in next 2 years. And it also has a catalyst to acquire very cheap land bank from cooperation with local SOEs. And last year, the company has done a very good thing, we think. The company last year started to sell a non-core asset to raise money. In our view, it is equaling to realized asset. So this is our topic for the China property sector. And that's all about China property I want to share with you. Thank you.